In light of the Fed minutes that we just got, in which they see a rate hike soon and they've set the stage for a more flexible path, how do you interpret Jay Powell's comments in light of the minutes? Chronologically, the minutes came before Powell's comments.
Well, I think that's a good observation. I think the minutes themselves don't really surprise anyone. I think the Fed has pretty well signaled its intention of raising rates in December and potentially doing one more in 2019. I think that what surprised the market yesterday and gave that big uptick in the equity market was, of course, the juxtaposition of Powell's October statement to the effect that rates were a long way from neutral, and I believe yesterday what he said is they're just below neutral. This, by the way, from a guy who says that he doesn't know where neutral is. So I guess this is just simply the Fed's body English in terms of communicating to the market that we're watching what's going on in the capital markets and we're prepared potentially to adapt our course of interest rates in a manner that would be more market friendly in the event that capital market conditions and asset prices go further south from where they've gone already.
Tad, were you anticipating that they'll go further south? Do you think it'll have to be one and done for 2019?
Well, I think that the Fed is looking at a lot of factors, obviously, but what happens in the equity market and in the credit markets is of, I think, very substantial concern to them, even though I think that they have actually more or less attempted to focus the market on things like growth and inflation and so forth. The reality is that what happens in the capital markets has a very outsized influence on the other variables that the Fed is watching. So answering the question about whether the Fed is one and done in 2019 is really asking the question about whether the correction that we've already experienced in the equity market is going to get more severe. If I had to make a guess, and it's just a guess, is that we're probably in line for at least a few more interest rate increases, because essentially what the Fed is attempting to do is to manage down, I think, what they perceive as excessive valuations in many different asset classes. While they haven't specifically called out any one in particular in terms of saying we've got substantial excess, I think that they have commented to the effect that there is overvaluation in a lot of places.